time. How do traders predict market movements with such precision? It seems almost magical, right? The secret often lies in their ability to read stock market charts. Now, when you look at these charts, they might just seem like a series of lines and bars, but there's so much more to them. They are powerful tools, and understanding them can be your key to making informed trading decisions. Let's break it down. Every movement on a stock chart tells a story. Sometimes it's a tale of confidence, and other times it's a cautionary note. One tool traders often turn to is the Bollinger Bands. These bands are like the pulse of the market, showing you when a stock is possibly overbought or oversold. When the price touches the upper band, it might be time to think twice before buying. But when it hits the lower band, some see it as an opportunity. Another indicator that often flies under the radar is the Fibonacci retracement. Imagine you're climbing a staircase, and every so often, you need to take a step back before moving forward. That's what this indicator helps traders see, a moment to pause before continuing a trend. It's not foolproof, but it adds a layer of strategy to the decisions. Then there's the moving average convergence divergence histogram, often just called the MACD histogram, a little different from the more common MACD line. This histogram provides a visual representation of momentum, highlighting shifts that might not be visible in the price action alone. It's like the market's way of whispering what might happen next. Don't overlook the check-in money flow, which digs into whether the big players are buying or selling. If the check-in money flow is in positive territory, it suggests that the smart money is flowing into the stock, a signal that could indicate future gains. But when it dips into negative territory, it might be wise to be cautious. Each of these indicators on its own tells a part of the story. But the real power comes when you learn to piece them together, like reading the lines of a book. It's not about finding a single indicator that holds all the answers, but about developing an understanding of how they interact with each other and with the market at large. The more you dive into these charts and indicators, the more you'll start to see patterns, to recognize when a stock is about to take off or when it's time to step back. And that's where the magic really happens. Understanding charts isn't just another skill to add to your toolkit. It's a vital part of becoming a successful trader. By mastering the art of reading these charts, you gain the ability to spot emerging trends, make well-timed trades, and manage your risks with greater precision. Whether you're a seasoned trader or just dipping your toes into the market, having a solid grasp of chart reading can dramatically improve your trading outcomes. It's the difference between trading blindly and trading with insight, between hoping for a win and strategically positioning yourself for one. The better you get at interpreting these charts, the more confident and effective you'll become in your trading decisions. Let's dive into the basics. One of the most fundamental chart types you'll encounter is the line chart. It's straightforward, connecting the closing prices of an asset over a given period, which creates a clear visual of price movement. This simplicity is what makes the line chart so valuable, especially when you're looking to identify long-term trends. If you want to get a quick overview of how a stock has performed over the past year, for example, a line chart is your best friend. It provides that broad perspective, stripping away the noise and focusing solely on the closing prices. This clean and easy to interpret format is why so many traders rely on it. It gives you a solid foundation, a starting point for deeper analysis. When you need to see the bigger picture at a glance, the line chart is the tool that delivers just that. But when you need more detail, that's where bar charts come into play. Unlike the simplicity of line charts, bar charts offer a more comprehensive view by showing you not just the closing price, but also the open, high, and low prices for each period. This extra data gives you a clearer picture of the price range within a specific time frame, allowing you to see the full story of daily price movements. Bar charts are particularly effective when you're focusing on short-term trading strategies. Understanding those intraday price fluctuations becomes crucial, and the bar chart lays it all out for you. Each bar represents the struggle between buyers and sellers, giving you insights into the market's behavior throughout the day. It's this level of detail that can make all the difference when timing your trades and making quick, informed decisions. Then we have the candlestick chart, a favorite among many traders because of its rich information and visual appeal. Each candlestick presents the same data as a bar chart: open, high, low, and close prices, but it goes a step further with its distinctive body and wicks. This design makes it easier to gauge market sentiment at a glance. For instance, when you see a long body with a small wick, it suggests strong momentum in the direction the body is pointing. This visual cue can be incredibly telling. Candlestick patterns like the evening star or engulfing pattern are especially valuable, as they can signal potential reversals or continuations of a trend. These patterns, when recognized, can provide critical insights into what the market might do next. Candlestick charts are not just about data, they're about understanding the psychology driving the market. They offer a way to see beyond the numbers and tap into the emotions and expectations of traders. This makes them invaluable tools for spotting short-term opportunities and gaining a deeper understanding of the forces at play in the market. Now, let's dive deeper into some key components of these charts. On any price chart, you'll notice that the x-axis typically represents time, while the y-axis represents price. This setup allows you to see how the price has evolved over specific periods. Whether you're looking at candlesticks or bars, each one captures how the price moved within that time frame, offering a snapshot of market activity. But there's another crucial element that often goes hand in hand with price volume. Volume shows the number of shares traded during a given period, and it's a powerful indicator of market interest. When you see high volume accompanying a price movement, it can confirm the strength of that movement, indicating that there's significant participation from traders. On the other hand, low volume might suggest a lack of interest or momentum, hinting that the price movement could be weaker or less reliable. Understanding these components show price moves over time and the volume behind those movements gives you a clearer picture of the market's dynamics. It's not just about seeing where the price is going, but also understanding the underlying activity driving it. This deeper insight is what helps you make more informed trading decisions. Reading trends is one of the most crucial skills in chart analysis. Spotting an uptrend, for instance, can be your signal that buyers are in control. An uptrend is characterized by a series of higher highs and higher lows, showing that the market is steadily moving upward. This pattern suggests growing confidence among buyers, and recognizing it early allows you to ride the wave and position yourself advantageously. On the flip side, a downtrend is marked by lower highs and lower lows, indicating that sellers are dominating the market. When you see this pattern, it's a signal that the market is losing value, and positioning yourself accordingly can help you avoid losses or even profit from the decline. Identifying these trends early on is like getting a head start in a race. It gives you the chance to make strategic moves, whether that means buying into an uptrend or getting out before a downtrend deepens. By honing this skill, you can align yourself with the market's momentum and make more informed decisions that can enhance your trading outcomes. Support and resistance levels are critical concepts to grasp in chart analysis. Support is a price level where a stock tends to attract buying interest, effectively preventing it from falling further. It's like a safety net for the price, where buyers step in and push the price back up. Understanding where these support levels are can help you anticipate when a stock might bounce back, giving you a potential entry point. On the other hand, resistance is the opposite. It's a price level where selling pressure tends to cap the price from rising higher. Think of it as a ceiling that the price struggles to break through. Recognizing resistance levels allows you to anticipate when the price might stall or even reverse, helping you decide when it might be time to sell or take profits. By identifying these support and resistance levels, you can better predict potential reversals or breakouts. This understanding provides you with strategic entry and exit points, making your trades more precise and your strategies more effective. Whether you're looking to buy into a stock at a lower price or sell before the market turns against you, these levels are invaluable tools in your trading arsenal. Let's put this into a practical example. Imagine you're analyzing a stock's chart to figure out your next move. You see an uptrend forming, with the price consistently making higher highs and higher lows, a clear sign that buyers are driving the market. As you watch the chart, the stock approaches a known resistance level, a point where the price has struggled to break through in the past. However, this time you notice something different to surge in volume. This increase in trading activity suggests that there's strong interest in the stock, potentially enough to push it past the resistance level. The combination of the uptrend and the rising volume gives you valuable insight. It tells you that the market sentiment is shifting, and the resistance that once held the stock back might soon be overcome. Armed with this information, you might decide to enter the trade, confident that once the stock breaks through the resistance, it could continue to rise. This blend of trend analysis and volume insight provides a strategic edge, allowing you to anticipate the market's next move and position yourself for potential gains. Managing risk is just as crucial as identifying opportunities, and this is where stop-loss market orders become invaluable. A stop-loss market order is a tool that automatically sells your stock when it reaches a predetermined price, helping you to limit potential losses. For example, let's say you buy a stock at $100. To protect your investment, you might set a stop-loss at $90. If the stock price drops to 90, the stop-loss order is triggered, and your stock is sold immediately. This action helps you avoid further decline, securing your capital from a deeper loss. By using stop-loss orders, you're not just relying on hope or market timing. You're putting a plan in place to manage risk effectively. It's a way to stay disciplined, ensuring that a downturn doesn't wipe out your gains or put you in a difficult financial position. In trading, protecting your downside is just as important as capturing the upside, and stop-loss orders are a key part of that strategy. Setting up a stop-loss order in RTrader Pro is a simple yet effective way to manage your trades and protect your investment. First, you select the stock you want to safeguard. Once you've highlighted your stock, navigate to the trading platform's menu and choose the stop-loss order option. Here, you'll enter your trigger price, a price at which you want the system to automatically sell your stock if the market turns against you. This straightforward process can have a significant impact on your trading strategy. By taking just a few moments to set up a stop loss, you're proactively managing risk and ensuring that your investments are protected even when you can't monitor the market closely. It's a small step that can make a big difference, giving you peace of mind and helping you stay disciplined in your trading approach. Now let's talk about entering trades, and that's where market limit orders come into play. A market limit order allows you to buy or sell a stock at a specific price or better, giving you more control over your trading decisions. For example, if you're interested in buying a stock but don't want to pay more than $50, you can set a market limit order at that price. This order won't execute unless the stock's price meets or falls below your set limit, ensuring that you don't end up paying more than you intended. Market limit orders are particularly useful when you're looking to enter a trade at a specific price point without chasing the market. By setting a limit, you can stick to your strategy and avoid the risk of overpaying, especially in a volatile market. It's a tool that helps you buy or sell on your terms, making sure that the price aligns with your expectations and trading plan. Stop limit orders offer an even higher level of control over your trades. They combine the features of stop and limit orders, giving you the ability to specify a price range for the execution of your trade. Let's break it down with an example. Suppose you want to sell a stock if its price starts to fall. You could set a stop limit order to trigger a sale if the stock drops to $48. But to ensure you don't sell for less than you're comfortable with, you might also set a limit price at $47.50. This means that if the stock drops to $48, your order is activated, but it will only execute if the price stays at or above $47.50. This setup gives you greater precision and control over how your trade is executed. You're not just setting a floor, you're also setting a boundary to prevent selling too low. It's a way to manage your position with more confidence, especially in volatile markets where prices can swing quickly. By using a stop limit order, you can better protect your investments while still taking advantage of market movements. When comparing these order types, it's essential to understand the trade-offs they offer. Market limit orders guarantee that you'll get the price you want, but they don't guarantee that the trade will execute if the market doesn't meet your price. This makes them ideal when price control is your top priority, but it comes with the risk of missing out on a trade if the market doesn't reach your specified level. On the other hand, stop limit orders provide a balance between price control and execution certainty. They guarantee that your trade will execute within a specified price range, offering more flexibility than a market limit order. This means that while you still have some control over the price, there's also a higher likelihood that your trade will go through, even in volatile conditions. The choice between these orders really comes down to your trading strategy and how you prioritize price versus execution. If getting a specific price is more important to you than ensuring the trade happens, a market limit order is your go-to. But if you need a balance, you wanting to control the price, but also needing some assurance that the trade will execute a stop limit order might be the better choice. Your decision will ultimately depend on how you weigh these factors in your overall trading approach. Let's shift gears and delve into some advanced chart reading tips. One powerful strategy is to use multiple indicators together with your charts to enhance your analysis. For example, pairing moving averages with volume analysis can be particularly effective in confirming trends and spotting potential reversals. Moving averages work by smoothing out price data, which helps you see the overall direction of the trend more clearly. Whether you're using a simple moving average or an exponential one, this tool can filter out the noise and reveal the underlying trend. But on its own, a moving average might not tell you everything you need to know. That's where volume analysis comes into play. By looking at volume alongside your moving averages, you can gauge the strength of the trend. For instance, if a stock is trending upward and you see increasing volume, it suggests that the trend is backed by strong buying interest. Conversely, if the price is rising but the volume is decreasing, it might be a sign that the trend is losing momentum and a reversal could be on the horizon. By combining these indicators, you gain a more complete picture of the market. The moving average shows you the direction, while volume confirms the strength behind it. This approach not only helps you identify trends with greater accuracy, but also equips you with the insight to anticipate potential shifts in the market, allowing you to make more informed trading decisions. Another valuable tip is to regularly adjust your chart settings to align with the ever-changing market conditions. The market is dynamic, and your charts need to reflect those shifts to keep your analysis sharp and accurate. One way to do this is by adjusting the time frame of your charts. If the market is particularly volatile, you might switch to a shorter time frame to capture more detailed price movements. Conversely, in a stable market, a longer time frame might give you a better view of the overall trend. Adding new indicators or tweaking existing ones is another way to keep your charts relevant. For instance, if you notice that a particular indicator is no longer providing useful insights, it might be time to replace it with something more suitable for the current market environment. You might also experiment with different settings on your indicators, such as changing the period on a moving average to see if a different approach yields better results. By keeping your charts updated and flexible, you ensure that your analysis stays in tune with the market. This adaptability is key to staying ahead of the curve, allowing you to respond to changes more effectively and maintain a strategic edge in your trading. Volume analysis is indeed a powerful tool in your chart reading arsenal. When you see high trading volume accompanying a price move, it's often a strong signal that the market has significant interest in that direction. This high volume suggests that many traders are participating in the move, which increases the likelihood that the trend will continue. On the other hand, if you notice that the price is moving but the volume is low, it could be a red flag. Low volume might indicate that the trend lacks conviction, meaning that fewer traders are supporting the move. This can be a sign that the trend is weak and could potentially reverse. By incorporating volume analysis into your chart reading, you gain a deeper understanding of market dynamics. Volume doesn't just tell you how many shares are being traded, it also reveals the strength behind price movements. This insight can significantly improve your decision-making, helping you to distinguish between trends that are likely to persist and those that might be short-lived or prone to reversal. Our Trader Pro provides a robust suite of advanced charting tools that are designed to enhance your ability to analyze various chart types effectively. The platform is highly customizable, allowing you to tailor your charts to highlight the most important data points that align with your trading strategy. You can easily adjust the time frames to suit different market conditions, whether you're looking at short-term fluctuations or long-term trends. The platform also enables you to add a range of indicators such as moving averages or Bollinger Bands, giving you the flexibility to analyze price movements with greater precision. Additionally, our Trader Pro allows you to set alerts for key price movements. This feature ensures that you never miss an important signal, keeping you informed and ready to act when the market moves. Whether you're monitoring a potential breakout or watching for a reversal, these tools help you stay ahead of the curve, making your trading more strategic and responsive. To enhance your chart reading skills, there are several practical tips and best practices you can follow. First, it's essential to make a habit of regularly reviewing your charts and adjusting them as needed. The market is constantly changing, and by staying on top of these shifts, you can maintain an edge in your trading. Don't let your charts become static, keep them dynamic and reflective of the current market conditions. Another key practice is to use multiple indicators. Relying on a single indicator might not give you the full picture, but combining different indicators can provide confirmation and increase the accuracy of your analysis. For example, pairing moving averages with volume analysis or adding trend lines alongside Fibonacci retracement levels can give you a more comprehensive view of the market. This multi-faceted approach helps you validate signals and avoid false positives, making your trades more strategic. Lastly, staying informed about broader market conditions is crucial. Understanding the larger context in which you're trading, such as economic news, geopolitical events, or industry-specific developments, can greatly influence your chart analysis. By keeping an eye on these factors, you can make more informed decisions and better anticipate market movements. This broader awareness allows you to connect the dots between what you see on the charts and what's happening in the world, leading to more effective and profitable trading strategies. As we wrap up, consider how you can apply these tips and techniques to your own trading. Think about which features of the charts you're most eager to explore and how you can tailor them to fit your specific trading strategy. Whether it's experimenting with different indicators, adjusting time frames, or setting up alerts for key price movements, there's a wealth of tools at your disposal. The key is to practice regularly. The more you work with these tools, the more intuitive and insightful your chart analysis will become. Over time, you'll develop a sharper eye for trends, better anticipate market movements, and make more informed trading decisions with confidence. So, what's your next step? What features are you most excited to try first? As you integrate these techniques into your trading routine, you'll find that your skills and confidence grow, making you a more effective and strategic trader. Share your thoughts on the techniques we've discussed today and stay tuned for our next session, where we'll dive into advanced trading strategies. Thanks for joining us, and remember, keep learning, keep trading, and we'll see you next